Welcome to GRE. I'm your host, Keith Weinhold. Over the past 5 years, the real estate market has changed forever. So what are you supposed to do now? Then I talked to two GRE listener guests back to back. Here's some relatable stories this week on Get Rich Education. Mid-South homebuyers, they're total pros. With over 2 decades as the nation's highest-rated turnkey provider, their empathetic property managers use your ROI as their North Star, so it's no wonder that smart investors just keep lining up to get their completely renovated income properties like it's the newest iPhone. They're headquartered in Memphis and have globally attractive cash flows, an A-plus rating with the Better Business Bureau, and now over 5,000 houses renovated. There's zero markup on maintenance, let that sink in, and they average a 98.9% occupancy rate, while their average renter stays more than 3.5 years. Every home they offer has brand new components, a bumper-to-bumper 1-year warranty, new 30-year roofs, and, wait for it, a high-quality renter. Remember that part? And in an astounding price range, $100 to $180K. I've personally toured their office and their properties in person in Memphis. Get to know Mid-South. Enjoy cash flow from day one. Start yourself right now at midsouthhomebuyers.com. That's midsouthhomebuyers.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. From Augusta, Maine to Augusta, Georgia, and across 188 nations worldwide, I'm Keith Weinhold, and you are back inside Get Rich Education. If you got trapped in a cave back in 2020, and then you came above ground into the sunlight of 2025 and wondered what happened to the real estate investment market over the last 5 years, here's the answer and what it means to you, even if you weren't trapped in a cave. And I sure hope you didn't have to fight off a bat colony either. During the pandemic housing boom of 2020 to 2022, housing demand soared. In fact, from March of 2020 to June of 2022, prices surged a staggering 43%, and rents ballooned too. And that was all amidst a few things: ultra-low mortgage rates, a remote work boom, and government stimulus. And for many, this unlocked Americans' work from anywhere arbitrage. High earners were able to keep their income in, say, New York City or LA, pack up their laptop, and head for state income tax-free havens like Tampa or Nashville. And builders could not keep up. See, housing supply stock is not as elastic as demand. It's like steering a cruise ship. It doesn't turn on a dime. Inventory was drained, and we had a full-on housing supply crash that dipped to its nadir in February of 2022. But just after that, all types of interest rates spiked later in 2022 to help stifle rising inflation. And what that did is that quickly quelled homeowner affordability. Return to office mandates began to gain momentum. National housing demand pulled back. A near 180 was quickly underway. Sales volume tanked, and that put a lot of people in the industry out of business. Realtors, mortgage loan officers, even furniture companies out of business. By 2024, prices in the single-family to fourplex space stabilized, just with a slow growth rate. But apartment values lost as much as 30% from 2022 to 24 due to devastating interest rate resets on their shorter-term loans. And meanwhile, the income required to buy a modest starter home rose from $49K in 2020 to $101K last year. That's per the NAR. And the term forever renter became both a meme and a reality. And since construction efforts to build have been uneven, apartment supply actually exceeds demand in a lot of markets. And over in the 1 to 4 unit space, by adding inventory, there's now 30% more available year over year, but it remains undersupplied nationally, especially, like I've discussed, in the Northeast and Midwest, where building has been meager to completely non-existent. That's why it can still feel impossible to find a house in much of Ohio or New Jersey, but you can rent an apartment in Austin, Texas faster than you can get a Wendy's drive-through order. Mortgage rates have now stayed in this same range of 6 to 7.5 for 20 months, and national home prices are up just about 2% in the past year. Now, when Trump began his second term in January of 2025, markets got giddy with business-friendly optimism, but this Trump bump, that reversed fast when he slapped half the planet with tariffs. Housing demand cooled again because no one buys a house when they feel like their job might vanish. All right, so amidst all of that, how do you adjust your strategy with what's changed over the past 5 years? Well, real estate still pays 5 ways, and since you're not betting it all on price growth like you would be with most other asset classes, this way you've always got a side to play. With affordability down, now rental demand is heating up. With more inventory on the market for you to purchase, there are more motivated sellers, especially those shiny build-to-rent homes. You do still have to deal with mortgage rates that are higher than they were 4 or 5 years ago. Refinance on the rate dips. If there's low inflation, rates fall. If there's high inflation, well, then your debt erodes faster. So this is what I mean about you having the ability to play both sides. Today, and this is big, the number of renter households are at a record high, and they're rising. Landlords are giving fewer concessions. Increasingly, they hold the cards in the single-family rental space, and annual rent growth is expected to heat up from its current 0 to 3%. Well, what is next? Short-term, housing values should stay stable, but not soar. And don't count on a big mortgage rate drop at all for the rest of the year. Long-term, expect more inflation and strong demographic demand. Those things are almost certainties, and that's the good part for real estate investors. So really, the overall market report card today, let's grade it out in a report card. Sellers are doing just okay. Buyers are strained. First-time home buyers are in the worst, the roughest shape. I mean, they grade out at an F. Single-family rental landlords are in good shape because people that want to buy a single-family home can't, so they rent. Apartment landlords, they are strained. And renters are holding steady. They're doing pretty well until steeper rent increases kick in. So really the bottom line here is that it's been a more tumultuous 5 years than usual. Housing demand lapped supply, and now it's coming closer back into balance. Today, home prices are stable, the amount of buyers are waning, and the hordes of renters are growing. And where are we today? Well, earlier this month, our president called our Fed chair a numbskull.
If we cut our interest by 1 point, for years, we save $300 billion. If we cut it by 2 points, we save, because it's pretty equivalent. We're going to spend $600 billion a year, $600 billion, because of one numbskull that sits here. I don't see enough reason to cut the rates now.
Oh dear, leaving you with a little knee slapper on the 5-year summary there. Look, poor and middle-class people feel like everything is expensive. That's because they pay for everything with money they've exchanged their time for. That means they feel like they're paying for everything with their life because they are, and that's exactly why money feels like a scarce resource. Instead, real estate investors pay for things according to what our assets are producing for us, and what other people's money is producing for us. And that's why we can pay for what we want. And money feels like an abundant resource, not a scarce one. That's what today's two listener guests discovered somewhere along their path, fueled by this show. Now, sometimes I answer your listener questions here on the show when you write into us at getricheducation.com/contact. Other times, I bring listener guests right here onto the show. That's what we're doing today. Today's both happen to be based in California. The first guest is a young investor, and the second guest more experienced. These were just recorded. Understand, they aren't professional speakers. And also, if you bear with a few early audio difficulties with our first guest, you're going to be rewarded with some relatable takeaways. Our first listener guest, Josh Fang, started listening to the Get Rich Education podcast as a college student in 2016 or 17. He first heard episode 84. That's when Robert Kiyosaki made his first appearance here. That episode was called The Rich Don't Work for Money. Then he went back to episode 1 and listened to them all, 560 episodes now. Let's meet him. This week's GRE listener guest is a 28-year-old real estate investor based out of Irvine, California. That's SoCal. And he has already reached what he calls semi-work optional status. Fantastic. He's been a GRE listener since 2017. That was at age 20 when he was a junior in college. The GRE podcast inspired him to become a mortgage loan officer, and he's become a top performer at doing that, originating loans. After graduating college, he used the money from that mortgage loan officer job, starting at age 22, to buy 5 income properties, 2 through Mid-South home buyers and 3 elsewhere, by the way. Again, he's 28 now. GRE quite literally shaped his adult life, and having enough passive income to fully retire is pretty much his only goal. Now he's got passion for talking financial freedom through smart borrowing, strategic thinking, and action over perfection. Oh, I love that. Hey, welcome to GRE, Josh Fang.
Thank you for having me, Keith. I really appreciate it.
Here on the show, I talk about borrowing and lending a good bit because if you're going to make something of yourself, you need to leverage the efforts of others. So tell us about how you got your first job in the mortgage industry and how it set the foundation for your investing journey, Josh.
When I graduated college in 2018, it was really rough. I had a business degree, which didn't really open up too many doors at that time. I couldn't find a job for 6 months. I was just applying everywhere that I could. Now, keep in mind, this entire time I'm looking for a job, I'm listening to your podcast and, how can I get the income and the money to purchase some rental properties for some passive income? And one company responded to my resume for a mortgage company. So I was able to get an interview, and I actually got the job by quoting, mortgage guidelines that I learned from your podcast, such as for an FHA loan, you need 3.5% down. For a conventional loan, you need 20% down. Just the most basic of the most basic mortgage guidelines. And I actually was able to land a job. And in the very beginning, they start you off pretty much, as a telemarketer, it's pretty rough, long hours, you work weekends. I was making $17.48 at the time per hour. And with that basic income, the $17.48 an hour, I actually was able to buy my first rental property without even a 2 years work history. And the way I did that was by using my college degree as work history, because there is actually a guideline to where if you have degree that is in the same field as where you work, it does actually count in work history. And it was really funny at the time I was living with my parents, another document that I needed to go through underwriting, I needed a letter from my dad, a signed letter from my dad saying I didn't pay rent because I was living at home. And off that $17.48 an hour, I was able to buy my first rental property. And from Mid-South home buyers, everyone there was so great. They were so helpful in helping me through the loan process, through selecting a property. And I was able to close. And the time that I bought my first rental, I was only 22 years old.
This is remarkable on a few levels with just those few lines about 3.5% down FHA or 20% down conventional. That sounded compelling enough for someone to want to give you an opportunity. And then off that modest starting wage, how that really helped you accumulate to buy income property. And yeah, when you're buying in those investor advantage places, those prices are low, but that's still pretty remarkable that you were able to do that. So talk to us some more about that. Buying your first rental property at age 22, surely younger than most people, about that process and the mindset and really that leap of faith that it takes, Josh, because most people are not doing this.
Absolutely. And I think I had a really big leg up in terms of mindset because I was starting to listen to your podcast when I was so young. When you're young and you're growing up and you're a young adult in college, you hear from your teachers, your parents, your friends, older people, and they say, oh, invest in the stock market, buy a primary residence to live in. And the big thing that I learned is I don't live in the same world as the world that my parents grew up in, and I can't invest the same as well.
Great point.
I live in Southern California. The medium house price of where I live in the city of Irvine is $2 million.
Yeah.
That's ridiculous. I would never, ever be able to purchase a primary residence out here. And buying stocks are at all-time highs. I mean, that's arguable, but I think stocks are quite overpriced. So investing there didn't make too much sense. And what you always talked about in terms of building a second flow of income, having that be passive to where I don't need to work regularly is what really motivated me to move towards that. And in terms of making the first step, I think the most important thing by far is just setting a goal, saying, at least for myself, it was, hey, I want to own a property. I want to provide safe, affordable housing to a tenant. And I want to be able to make money off of that to where I don't need to do something physically for it every single day. And then after that, it's just about taking the steps. The first things first is I reached out to some of the house providers. In that case, it was Mid-South home buyers. Gave them a call, spoke to them, say, hey, can I please be put on your list? Perfect. Then it was just continuing doing the work, doing more research, continue listening to your podcasts, learn tidbits here and there, lots of Googling, looking up terms that I didn't understand. When I read through the analysis of the property, hey, what does this mean? What does that mean? Googling it, learning one step at a time. And then when it came time and I was actually receiving properties that I could buy, it was about getting the mortgage. And it was about, hey, let's just move one step at a time. Okay, today I need to get these documents. And the next step, I need to get these documents. And before you knew it, I was signing with a notary closing on my first property.
The autodidactic approach, meaning the self-taught approach with some assistance from my show. But yeah, oftentimes listening to the show can be the stimulus to make you want to learn more, probably because I talk about the why for real estate. And if you don't know your why, you won't care about how. So Josh, are you doing something that some people do in high-cost areas like you live in SoCal? Are you renting your own place and then you provide rental housing to others outside your own area in Investor Advantage places? Is that your setup?
100%. Where I live in Irvine, it is extremely, extremely low crime. Everything's a planned unit development. It is beautiful out here. There's trees. There's lots of different foods from different cultures. I absolutely love living here. The only issue is it's ridiculously expensive. I live in a very nice luxury apartment complex. And I pay an extremely high rent that normal people probably wouldn't be able to pay. But rather than coming out of my pocket, I use the cash flow for my rentals to pay for my rent over here. So it's kind of like I'm building equity, even though I'm just renting. And I get to live the life that I want to live, where I want to live it, while still being able to invest the proper way, in my opinion.
That's beautifully said and well thought out. And part of doing that, Josh, is this borrowing money, which I think to lay people is scary. And for someone in their 20s to borrow money, that could really bring a good bit of trepidation because that goes against the grain of what so many people do. But of course, we talk around here about how borrowing money, like you have for your rental properties in other states outside California, really is not something to fear. So can you tell us more about how you approach that mindset?
Absolutely. And it's always hilarious when someone asks you if you have any debt and you tell them $500,000 when you're 23, 24 years old. The biggest thing about borrowing money is, now again, there's different types of debt. So I'm not saying, hey, go buy some expensive car that you're going to be backwards on in a few months. Don't get a bunch of credit card debts at 24% interest rates. I'm talking about debt from with a collateral attached to it, such as a mortgage. The way I like to think about borrowing money is borrowing like a bank, because your money has value. Whenever I have money in the actual bank, it doesn't feel like it, but I'm actually lending money to the bank. They're taking the money that I have deposited and lending it out to other people at higher rate than what they're paying me back. That's how they're actually making the money. I'm thinking like a bank. And of course, that's exactly how it is with borrowing money for rental properties. The interest rate that I have to pay on my mortgage is so much lower than how much income I'm receiving by actually renting it out and providing housing for someone. And then, of course, tax deductions.
Sure, you're creating arbitrage there. When it comes to paying off or aggressively paying down a property, I mean, some protection financially is surely good, but one has to realize that after some point, when you protect, you cannot produce. Another way to say it is if you use your dollar to pay down, then you cannot use your dollar to multiply.
I agree with that 100%. I couldn't have said it any better.
You really took action, something that a lot of people don't do. I don't think you did right away. You listened to some episodes for quite a while, but you did overcome analysis paralysis at some point. So talk to us about more with that mindset of how you took the first step, even when you're still perhaps a little unsure.
I think you say it best. And I know I'm literally taking the words out of your mouth because, again, I'm a longtime listener, but do the right thing before you do things right.
Yeah.
Just rings so true. You're never going to be perfect. There's never going to be the perfect property. There's never going to be the perfect deal. Eventually, you just have to do it. And again, all it really is saying, hey, here's what I want to do and what are the steps that I have to take to get there. If the first actual step, rather than just listening to the podcast or getting more information, if the first step is, hey, I want to get a pre-approval, go ahead and get it done. Reach out to a loan officer, get your pre-approval, get the documents needed, get the right information that you need, and then start writing offers on properties or contacting Keith and his team, their GRE mentoring team, and ask for property values. And once you find one, and again, you're never going to find the perfect property. Once you find one that you say, hey, this fits enough, jump on it. You should be excited. I mean, again, once you're doing the right thing, you can learn to do things right and slowly kind of say, hey, I made a small error there. Hey, I made a small error there. But at the end of the day, you move forward and you're ahead of where you started. I think that's the most important thing.
Yeah, I think uncertainty stops some people, maybe even uncertainty with the larger economy, or maybe people just look for excuses for inactivity sometimes. There will always be some uncertainty out there. And what you do when you make an offer on a real asset is you just made some certainty in your life. Yeah, just talk to us more about the process of kind of you started with your first property and then growing that portfolio. And what did you learn between the first one and that second, third, fourth, and fifth one where you are now?
After buying my first one, when I received that first rent check, after that first rental property, my net cash flow after management, expenses, putting a little bit, VIMTIM,
Yeah.
keeping an extra 10% away to just keep in the bank in case something came up. I was cash flowing at the time $231. Doesn't sound like a crazy amount now, but as a 22-year-old kid and saying, hey, I got this $231 without lifting a finger, felt amazing. I had this feeling. I'm out in Southern California. We have this burger chain called In-N-Out. My double burger and fries combo was about $6 at the time. And I said, no matter how bad things get, that $231, I can buy an In-N-Out meal every single day as long as I own that property. I just had such an overwhelming feeling of when can I get the next one? I immediately reached out to Mid-South like, hey, put me on the list. As soon as I have money. You know what, Keith? It got fun. Every time I got an email saying, hey, here's another property, I'm like, wow, if I can make this deal work, that's an extra couple $100 I can have at the end of the month every single day. And now I live in my own apartment complex, in a unit in an apartment complex. But at the time, I rented out a room in a house, in a condo, just a single room. And by the time I bought my second rental property, all of my cash flow from my two rentals actually covered the full amount of my monthly rent living outside of my parents' place. And that just felt so amazing because it was like I almost had no overhead. So all the money that I was making from my job was completely disposable that I could use to purchase other rental properties. And that was just such an amazing, freeing feeling to know that no matter what happened, I obviously, as long as there's no vacancies or any kind of crazy issues there, that I would still have that flow of income coming in. Pretty much after buying my first one, all I wanted to do was buy more. Now, a big issue that happened was 2020 and 2021, there was very little inventory. So it's really tough and slim pickings. And I would have bought a lot more if I could find more deals. And now thinking back, I should have. If anything, I wish I bought more.
Gosh, I just love that, Josh. That seminal $231 cash flow from that first property, and how you rationalize that could buy you an In-N-Out meal every single day, all month, if that's what you wanted to do with that first one. That's terrific. And yes, markets change. There's more inventory available now than there was in 2020 and 2021. Mortgage rates are surely higher. You don't have as much competition. You might even get a concession or two when you buy, since it's a more balanced market today than it was about 4 years ago, for sure. So every market cycle is different. When you realize you're paid 5 ways at the same time, there's always one side to play or the other. There's always so many variables that you get to deal with there. Have you had any certain issues with property management, or do you have any mindset about using a property manager remotely? I assume you're using remote management for these turnkey type properties. Is that right?
100%. I've actually never physically seen any of my properties.
Yeah.
What you say is the best, essentially. Your team that manages your property is the most important by far.
Right.
Right. Now, here's the thing. Issues are going to come up regardless of what happens. There's always going to be something that breaks eventually. There's always going to be vacancy eventually. There can be natural disasters. Something's always going to come up. And the thing is, you can't get angry about the things that you can't control. If there is a vacancy that, you vetted the tenant properly and there was nothing to do, if there is a natural disaster, or if something does break down in your property that you couldn't have expected coming or that wasn't your fault, the biggest thing is you can't get angry with it. You just have to know that you can deal with it properly. And having a professional team on the other side saying, hey, we're going to handle it. This is an issue. Here's how much it's going to cost. We got a couple of, quotes. Please approve one when you get a chance. And knowing that the other side will be able to execute on that and to do it for you, and that you don't have to fly out wherever you own your property and do it yourself physically, or have to call around and find a contractor to do it. It's a huge peace of mind. And having a property manager and a team that you can trust just makes it work. If I couldn't get a property manager that I trusted, I wouldn't own the property in the first place. It's just too much work.
I am the same way. I also have not seen the majority of the properties I own. I've never seen them physically in person. Yeah, having a professional property manager, they provide a buffer and they help keep this investment unemotional for you. And mistakes happen when people get overly emotional about their properties. Some people are reluctant to hire a property manager, Josh, because they don't want to pay the 8 to 10% property management fee, which can actually be a little bit more than that effectively with leasing fees. But people feel that way as oftentimes they're confining and limiting their search to their own local market, which probably isn't investor advantaged. So they don't have enough of a cushion in their pro forma, in their profit and loss statement to pay for a property manager. But when you buy in those investor advantage places where you get that high ratio of rent income to purchase price, there you have the allowance to pay for the manager too.
100%. And luckily, because I have my foundation of real estate from listening to your podcast, I never even look at a deal without factoring in the fact that there will be management. I have never, ever even possibly considered self-managing.
Right.
It just makes no sense. I'd rather, let's just say it's 10% and a month's worth of lease, which is a little bit on the higher end in terms of management fees, right? Even if I were to do, I would factor that in 100% of the time. If the deal doesn't work, if it doesn't cash flow, if it doesn't, appreciate a certain amount, if it isn't in my ballpark with the management fees taken out, that's not even a deal that I'm looking at. It's just too expensive.
Yeah, that's a great way to think about it. Keep it unemotional and make it all relatively passive. I self-managed for the first 6 or 7 years of my real estate investing career, but that's because I was only investing in my own local market and I was thinking small and I didn't learn about finding the best investor advantaged places nationwide. Well, Josh, as we wind down here, is there any last thing that you'd like to let the audience know or to tell us? I know before we recorded, you had talked about how really your daydream is more realistic than you think and the motivation behind getting started. What do you want to leave with, Josh?
You say it after every podcast, don't quit your daydream. I've been hearing that for 8 years now at this point, and it really is. I don't have a day job. I pretty much only work when I feel like it. The majority of what I've lived off of is the income properties that I've bought and the lifestyle that I've crafted. It's so freeing. No one's telling you what to do. You don't have to go somewhere every day. You can spend time doing what you want. when I first quit my day job and, went into this semi-retirement, I'm not going to lie. I play video games 8 hours a day for months, for maybe a month or two. I don't know if that's the most productive, but the fact that I could do that, I could obsess on crazy hobbies for a while was crazy. But one of the most important things to me of being able to reach this point in my life is I'm starting to get a little bit older. I am able to spend time with my family. I am able to spend time with my grandparents. And, just like on a Tuesday or like on a Wednesday, just when nothing's really going on, just being able to stop by and say hi to my family and spend time with them is something that I'm so blessed to be able to have and not many people can do. And then the last thing I'd like to say on that is just there's very small things in the world that a lot of people don't get a notice because I feel like everyone's in a rush all the time. And a lot of people are, if you're working 40 hours a week, 9 to 5, 9 to 6, there's not much time. But the other day I was taking a small hike and I saw a group of lizards. I thought they were cool. So I looked at the lizards. I spent maybe 15 minutes watching the lizards. And I wasn't in a rush, I could just enjoy the small things in life. And that's one of the best things in the world, to just have that sense of not being in a rush. And I feel like investing in real estate and having that passive income and having that level of freedom, to me, that's what my daydream is. There's nothing better to me.
The simple pleasures about not having your time so confined that you could enjoy looking at lizards for 15 minutes. I love the small stuff like that. And does this mean, Josh, with 5 rental properties, that you only need to work part-time rather than full-time? Because usually 5 properties don't allow someone to completely leave the workforce.
No, not at all. I definitely do things on the side. I still do loans for friends and family. I do some other stuff on the side, but it's more of that my basic needs are met for the most part.
That's terrific. You've got more latitude to live, and having a life of options trumps having a life of obligations 100%. Well, hey, it's been great hearing your story, Josh. Loved having you here on the show. You're listening to Get Rich Education. We got to know listener guest Josh Fang more when we come back with another listener guest profile. I'm your host, Keith Weinhold. The same place where I get my own mortgage loans is where you can get yours. Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Chaley Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com. You know what's crazy? Your bank is getting rich off of you. The average savings account pays less than 1%. It's like laughable. Meanwhile, if your money isn't making at least 4%, you're losing to inflation. That's why I started putting my own money into the FFI Liquidity Fund. It's super simple. Your cash can pull in up to 8% returns and it compounds. It's not some high-risk gamble like digital or AI stock trading. It's pretty low risk because they've got a 10-plus year track record of paying investors on time, in full, every time. I wouldn't be talking about it if I wasn't invested myself. You can invest as little as $25K, and you keep earning until you decide you want your money back. No weird lockups or anything like that. So if you're like me and tired of your liquid funds just sitting there doing nothing, check it out. Text FAMILY to 66866 to learn about Freedom Family Investments Liquidity Fund. Again, text FAMILY to 66866.
This is author Jim Rickards. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Our next listener guest has an uncanny amount of similarities with me. Like me, he was a geography major in college. He had humble beginnings in upstate New York, not far from where I grew up in upstate Pennsylvania. He's a huge believer in real estate pays 5 ways, and he loves world travel. His first job out of college was, in fact, traveling the world playing basketball against the Harlem Globetrotters. We sure don't have that pro basketball part in common. He owns dozens of units across 7 states today. He's listened to GRE for 6 or 7 years, and he was a corporate corporate guy living in California who thought the book Rich Dad Poor Dad was fiction until he experienced the rapid appreciation of he and his wife's first primary residence. And after that appreciation, he knew he had to acquire more real estate. Prices were too high in California relative to rent, so he went out of state, and he had just one property for 5 years to learn. That was pretty similar to me as well. And then he saw tremendous opportunity after the GFC hit in 2008, and that really put him on a path through experience, the 5 ways real estate pays over time, and he became convinced that there's not a better risk-adjusted business model that's easily accessible to the average person. Hey, welcome to GRE, Nate O'Neill.
Keith, it's great to be here. I've been, as you mentioned, a long-time listener. Really appreciate the content that you put out, and excited to be on the show.
And you're no longer playing like zero defense basketball against the Harlem Globetrotters. You work in the solar industry now. I know that you sell to single-family rental REITs. That's really interesting. And one thing that real estate investing lets people do is think differently about their W-2 job. So tell us about how that manifests with you, Nate.
Growing up, the first 25 years of my life, 24 years or so, my identity was wrapped up as an athlete and, something I could really get excited about. Eventually that had to come to an end, and started working in the corporate world. So did that for a little while and got going. It really, didn't resonate with me that much. But, I had a wife and I had some kids on the way, so I had to keep grinding it out. And, as I did that, I discovered real estate. And what really helped me with that was I saw the corporate world began to be a vehicle to grow my real estate portfolio, right? Instead of it being the desk jockey in the cubicle, my corporate job was, okay, this is the way for me to raise capital and get the best loans to build a real estate portfolio. So, and it's ironic because as that kind of evolved, I gained, more appreciation for the corporate job, and it wasn't so burdensome. And I know there's probably a lot of people out there, right, that feel that way about their job, but you can probably do a mindset shift and say, hey, this can serve me in other ways and it not be such a grind.
That's a great way to think about it. While you have that job, it sure is an asset in helping you qualify for loans. Right before I quit my job, I made sure I qualified for as many loans as I could because I sure would have had a hard time getting them immediately after leaving my job before I built income or build up passively from something else. It's funny, when you're in the corporate world, you're in this context of normalcy. So many people that you know are working. You're around your coworkers all day. They're working. And if it's something you're not passionate about, you still don't question it because it takes on that context of normalcy. But once you leave your job, it feels bizarre that anyone would ever show up and spend 5 of their 7 days and most of the waking hours of those days doing something that they're not passionate about. Now, maybe you are passionate about what you do. That's sort of the mindset that I think through there. But that's a good way to help a person feel a little bit better showing up at their job, even if it is a soul-sucking job, Nate. So talk to us about this more with this sort of power of purpose that you had. And when you are working your day job, you probably do some living below your means in the short term, but a lot of people just do that decade after decade and grind it out. So how do you think about that with the mindset in this sort of capital formation stage in order to acquire more property while you're working?
Like I said, it was an opportunity. The job became an opportunity to fuel the real estate business, which, as you mentioned, I saw that opportunity in 2009, right, when prices were low, when interest rates were low, when there was a bunch of nice new foreclosures on the market. I saw it created a sense of urgency in me, right? So I was like, all right, let's go to work because the work's going to drive that capital, and the capital is going to allow us to acquire more and more of this real estate, which is, again, something I was passionate about because we had just that one rental for that 5-year period. I saw the power of what it can do over the long term. And when you have that purpose and that clarity, then all the minor stuff that you can get wrapped around and can kind of slow you down really doesn't matter. You have that big vision and that big goal that you're going after that really kind of drives you.
Now, before we got started today, I learned that you have a few ways of thinking about how real estate investors can have their cake and eat it too, more tactically here. Tell us about that. And of course, what is the point of having cake if you can't eat it?
Yeah, for sure. I worked in some different industries and some different companies and seen a lot of different business models. I've never found anything where you can have kind of both sides of the cookie here or have your cake and eat it too. You can depreciate an appreciating asset. The government allows you to depreciate homes, right? Which gives you a nice tax benefit. The money that I make at my corporate job is taxed at a much higher rate than my real estate income, but yet the asset actually appreciates. So you depreciate an appreciating asset. I think people underestimate the power of the 30-year mortgage, right? You can lock in an interest rate today for 30 years. And if interest rates go up, you did a great job. You locked in a great rate. If interest rates go down, you're a champion if you just refinance. When you do a 30-year fixed rate mortgage, the lender is committing to you for 3 decades, but you don't have to commit to them. So again, have your cake and eat it too. And then, the whole return on amortization that you talk about, Keith.
Yeah.
When you get to borrow money that you don't have to pay back in essence, right? The resident that's in your home is paying that money back. So people think about, they hate getting bills in the mail. I actually love getting my mortgage statements in the mail.
Right.
Every month, I go through this little ritual. I look at it, and my process is, wow, how much was that principal paid down, right? I didn't pay it back, right? The rent payment paid it back. So what other scenario can you borrow money that, quote unquote, someone else is paying back on your behalf?
That ROA, that return on amortization, also known as principal paydown, where yes, you get that statement every month and you get to see how much a stranger paid down for your property. It's basically a stranger every month is faithfully funding an illiquid savings account for you.
It's just incredible. And then the final way I kind of think about having your cake and eating it too is this HELOC strategy. So over time, as you build equity in your portfolio, you can take out a home equity line of credit, right? And the beauty of a line of credit is you open it up and you don't have to make any payments if you don't use the money. But when there's an opportunity, you can pounce on that opportunity. And this is what we did in 2020 and 2021. We acquired some new construction fourplexes with HELOCs. And when in using the HELOC strategy, you're able to use every single dollar to keep the balance low. And what it does is it creates this virtuous cycle of increasing cash flow. Because it's a line of credit and you pay off against that line of credit, if you need the money back for an emergency or if a better opportunity comes up, then you basically just pull more off that line of credit. But if you don't have that opportunity, that emergency, then your money is fully working to keep that payment low, which increases your cash flow. And again, it creates that virtuous cycle of increasing cash flow, which you can use to pay down the HELOC even more.
I see no downsides to getting a HELOC, to getting a line of credit against your existing primary residence or your rental properties, whatever they are. It's like this flexible credit card where you're drawing on it with your property as collateral, and it's at lower interest rates than a credit card is going to be. And you also have interest-only flexibility, meaning even if you draw against it and you do have a balance and you need to make a payment, therefore, you can pay as little as only the interest portion if you want to. In fact, when I bought my first fourplex, in order to fund my second fourplex, I took a HELOC second mortgage off of that first one. Love the HELOC. Really can't think of any downsides with at least having it there, and then it's up to you as to whether you want to draw against it or not.
Absolutely.
Talk to us more about you're another out-of-state investor based in high-cost California there. It sounds unusual to lay people, but here we are as successful investors owning these properties, typically that we have never seen out of state. Are you in that category as well? And talk to us more about the out-of-state investing experience.
I've only ever seen one of the units that I own, the rental units that I own. And I actually think it's a huge advantage because if you're seeing them, driving by them all the time, there's probably little nits that you could point out and, you get some kind of emotional attachment to them. The way I look at it, it's two things. Number one, it's the spreadsheet behind it, right? What are the numbers behind it? What is my mortgage payment? Is there HOA? Taxes, insurance, all that stuff, and what is my rent? And obviously, I'm all about cash flow, so that rent payment has to cover all the expenses with a little extra. the second piece of it behind the spreadsheet is the person managing it, right? And I've been very fortunate over my years of investing to find some really quality property managers who I know I can trust. So, absolutely. I mean, developed an ability to hire the right people to manage the property, and they handle just about everything. And I just need to be there available for them if they have questions for me or decisions I need to make, fully trust them. I have only ever seen one of the units that I own and, never really planned to go out and visit them.
You do like to travel, but just not necessarily to your 200K turnkey single family home in the Midwest and the South, not where you want to stay. There are some advantages and some disadvantages of owning rental properties, say 4 blocks from your home. One of the distinct disadvantages is, you might get that emotional attachment to it. You might get bogged down in inconsequential things. You might drive by and see that the hedge needs a trim. How much of a problem is that really?
Exactly. As long as the spreadsheet behind it is spitting out the right numbers and you have someone that you can trust that can handle anything that's major or any tenant issues, that's all that's really relevant.
Has our investment coaching helped inform you at all? Helped you find properties or give you inside information or access to deals or other support?
Yeah, I have had a conversation with Naresh, one of your investment counselors. Haven't necessarily acted upon that, but I can say over the 6 to 7 years that I've been listening to your podcast, just understanding kind of the macroeconomic guests that you bring on and the markets that we believe are good for investing, like that information has been extremely valuable to me over the years.
Our coaches are really deal scouts. Here in today's market, for example, things are just so much different than they were during the 2008 GFC years. There are always deals in every cycle. You typically just need to shift and find out where those opportunities are. Are there any specific niches or opportunities that you're exploiting today in this particular cycle, Nate?
Yeah, so it's really interesting, and I've been spoiled, right, in terms of the times when I did a lot of my acquisition back in 2008. We knew it was good, but looking back, you realize just how good it was at that time. And frankly, now it's very challenging, right? I mean, affordability is the worst it's been in 40 years, right? So you have to be really creative. One of the things that I did recently was I learned how to do a loan acquisition. So assuming a loan can be very helpful, right? Where you're not dealing with today's interest rates, you can get yesterday's interest rates on a property. So that's been one thing, and one thing I continue to look at. I also believe that I've been focused on single family and some fourplexes. I'm looking at smaller multifamily because what I've learned is there's opportunity when there's debt disruption, right? The great financial crisis happened because there were atrocious lending standards leading up to that time, right? So that opened up a window of opportunity. That opportunity is closed. Acquired some fourplexes in 20 and 21 when interest rates were unbelievably low, right? Basically, the Fed funds rate was basically zero. That kind of unique debt situation allowed me to acquire there. And now, right, since 2022, interest rates spiked so quickly. The way I think about it is there's debt disruption period. There's probably some acquisitions that happened with 3 to 5 year short-term loans that are going to be coming due. And those acquisitions are facing payments that are going to double. So there could be some motivated sellers, not in the single family, right, where you have 30-year fixed rate or 15-year fixed rate, but in those small multifamily loans where they have those short-term variable rate debts. So that's kind of how I'm thinking right now.
That's perceptive. It's something I brought up on the show a month or more ago, where apartment buildings have got to bottom out at some point, those being sensitive to those shorter term interest rates. Well, Nate, this has really been helpful. You've given our audience quite a few things to think about. Is there any last thing that you'd like the audience to know?
We talked a little bit about purpose. Like, that's very important. There is no better way, in my opinion, to build wealth for the average person. No more predictable way, risk adjusted, to build wealth for the average person. For the listeners out there, it's great that you're consuming this content. And if you can find a purpose behind it, then it'll help. And the other thing is get clarity, right? There's a lot of different things you can do within real estate investing, but get clarity on what works for you. And the way to do that, frankly, is just kind of sit and think. I think, especially in today's day and age, there's so many stimulus coming at us from social media to everything that there's a risk of not being able to get clear. One of the big things that helped me during that period of 2009 to 2015 when we started to scale was I was very clear about what we wanted. I had a buy box that was, homes built this millennium, B-grade neighborhoods, cash flowed $300 or more with no more than 25% down in markets with population growth, job growth, and favorable rent to price ratios. And when I was able to communicate with the agents and property managers, I was very clear on what we wanted to do. They had clarity on what they needed to do to help us scale. So purpose and clarity.
That's great guidance, a specific buy box. Yes, focus is harder to find, and it's really important today. It's amazing, Nate, how much work I get done when my phone is one room away over on the charger. It's incredible how that works. Well, it's been good to get your insight, and it's been good to talk to a guy that might know the capital of Argentina, much like I know, a fellow geography guy and real estate investor. Yeah, I really want to thank you for sharing your insight with the audience today, Nate.
I hope it's valuable for you and the audience.
Oh yeah, good, relatable material this week. The first guest, Josh, also talked about how he took out a low interest rate car loan. So he held on to those funds rather than handing them over to an auto dealer, stayed liquid, and used it for income property, creating a yield for himself that beat the car loan interest rate. Pretty smart. And before you do that, you do want to be sure that you've got enough liquidity to service debt. And then Nate, the second one, the more experienced investor, reminding us that deals are not as good as they were coming off the global financial crisis. And he's right, but I still don't know of a better risk-adjusted return today. Like me, they both use professional property management. I mean, you do have the option of self-managing your property remotely that you get from GRE Marketplace. But of all the things in the world that you can learn about, even all the things in real estate investing that you can learn about, is self-managing really what you want to spend your finite resource of time learning about? Even if you've got good tenants, you're bringing more intrusion and interruption into your life. Property managers don't just protect your asset, they protect your time. Big thanks to GRE listeners Josh Fang and Nate O'Neill today. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
You know, whenever you want the best written real estate and finance info, oh, geez. Today's Experience limits your free articles access, and it's got paywalls and pop-ups and push notifications and cookies disclaimers. It's not so great. So then it's vital to place nice, clean, free content into your hands that adds no hype value to your life. That's why this is the golden age of quality newsletters, and I write every word of ours myself. It's got a dash of humor, and it's to the point because even the word abbreviation is too long. My letter usually takes less than 3 minutes to read, and when you start the letter, you'll also get my 1-hour fast real estate video course. It's all completely free. It's called the Don't Quit Your Daydream letter. It wires your mind for wealth, and it couldn't be easier for you to get it right now. Just text GRE to 66866. While it's on your mind, take a moment to do it right now. Text GRE to 66866. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.